Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Letter and the Banking on Profit newsletter service, coming to you from a really nice hot day down here in Central Florida. I just love this kind of weather. Now, those of you paying attention, and hopefully some of you are, may have noticed that I did not send out my usual fun-filled market overview on Thursday. Wife had a little outpatient surgery, and I had to stay home and kind of play nurse for her. And of course, I'm not very good at that, but she did survive in spite of that fact, and things are back to normal, and we'll be back to our regular schedule in the week coming up. Market continued to move higher with the S&P up 1.77% this week. The All World Earth Index came up about 1.55, and our little community banks kind of kicked it into gear, rising as measured by the QABA Community Bank Index ETF by about 2.53%. So a pretty solid performance for the community banks again this week. All eyes this week, still going on in the Middle East and in the Ukraine. Nobody really cared. The real focus this week was on central banks. We had a ton of information coming out. Janet Yellen continues to have to walk a very difficult tightrope. She's doing a pretty good job of it with her remarks, letting people know that eventually we are going to have to raise interest rates. But I think that she's very much aware um, that if she says the wrong thing at the wrong time, she could very well send interest rates moving higher quicker than she wants and bring the stock market crashing down around her ears, creating a situation that, in fact, the Fed no longer has the tools to fight. So she's walking a tightrope. It's got to be the least attractive job in the entire United States. I just don't think they pay enough money to try to micromanage an economy that is as damaged and confused as currently the United States economy is. But she's got it better than Mario Draghi, folks. Bond yields over there have just collapsed. They're at multi-century lows. I was reading the other day, the Spanish bond yields are at the lowest rate since the French Revolution. Um, it was Spain and Italy and France providing the drag, and they're still a mess. Unemployment rates are through the roof. France, in particular, just cannot get it together, and unemployment is terrible. That's almost to be expected. The socialist government in place, they made a lot of reforms that cripple business. They're having a hard time backing away from that situation now. France is a mess and will remain a mess for an extended period of time, I think. Now, Draghi did tip at the Jackson Hole meeting that it is time for Europe to move a little bit more away from austerity because that clearly has not worked. It's made things worse as far as jobs and economic growth, and in the direction of a more stimulative attitude. A lot of market observers think they need to get real stimulative real fast and take some additional measures to try to fire that economy up. Now, it's interesting to me when the economy is this much of a mess that they're doing the stress tests, and the criteria are pretty severe. We covered that a few weeks ago, but they're really setting up a doomsday scenario that these banks have to pass. And if a lot of these banks end up failing this test when the results are announced in October, that's going to create an additional problem for Europe. It's also creating some bargain banks. We've been kind of just holding off, waiting, but they're all getting to that 50% and below level of book value where we like to get into the more distressed large bank situations. And of course, some other, especially in Germany, with the German economy now weak for the first time, no longer carrying Europe on its back, we were able to pick up a large European food concern based in Germany at 70% of book value this past week. So Europe's mess is creating a little bit of opportunity for us. Not as much as I'd like to see, but a little bit in the international portfolio. The Bank of Japan, of course, Japan's economy took a much harder hit than the government had originally expected as a result of what I have to say is a misguided sales tax increase back in April. People stopped spending after the sales tax increase went through. Now their governors are talking about stimulus for an extended, very long period of time, language much like the Fed has been using since 2009 in order to get that economy back on track. Now, they've been working on this since the 1990s and nothing's taken so far, but we have a good position in Japanese equity, so I sure hope they get it right at some point in time going forward. Now, the central banker that nobody wants to talk to, and he certainly was not invited to Jackson Hole to pour cold water on the rest of the world, is Indian Central Bank Governor Raghuram Rajan, whose name I probably just horribly mispronounced. But he's the one that warned us back in 2005 at Jackson Hole, the last time he was allowed to speak there, that the global markets were too risky, there was way too much leverage, too many different types of derivatives in the system, and that this could bring the world economy crashing down around our ears. That was totally not in anybody's game plans back in August of 2005. Everybody had a very rosy picture of the world. Took about 2.5 years, but Mr. Rajan was proven right, and the world did, in fact, crash down around our ears. Well, everybody else is in Jackson Hole. He's not, but he did give some remarks last week, and he is warning that the super low interest rates and the continually aggressively stimulus fiscal policies are setting the stage for a lot of problems that the world's central banks are not prepared to handle at this point in time, and that asset prices have in fact been pushed far beyond their fundamental value. You've heard a lot of other people saying similar stuff. Seth Klarman, one of the brightest guys on the planet, has made remarks along those lines, as has Sam Zell. Now, Mr. Rajan has been right before in a spectacular fashion in evaluating the global economy. So it's worth just kind of ticking up your interest a little bit and saying this guy could be right and we need to be careful. Now, fortunately, our devotion to deep value keeps us from being overinvested when there's not a lot of cheap stuff around. So if stuff does in fact come crashing down around our ears, we'll be in pretty good shape because we've got a lot of cash. And we also have some mining stocks that in a crash, the rise of prices in some of the precious metals could be very good for us as well. Anyway, existing home sales report came in. The headline number was not bad. Rise 2.4% over June. Looks pretty good. But again, you go in, you keep looking at these numbers. We're still 4% below last year's existing home sales levels. Housing is okay. It's not the disaster that it was 5 years ago, but it's sure not pushing the economy in the direction a lot of people had hoped would happen. Now, the housing starts and permits number looked fantastic on a headline basis earlier this week. They were up, by significant percentages across the board. One of the strongest reports we've seen in a couple years. And at least one research firm, HousingWire.com, dug down into these numbers, and in a report from them that I read, they said on a non-seasonally adjusted basis, all of the improvement was in multifamily homes, and that single-family home starts and permits, non-seasonally adjusted, were basically flat year over year. So, and I love seeing the strength in multifamily. We owned a couple of REITs, multifamily REITs, that are deeply undervalued, trading, well below 80% of book value, suggesting that as that market heats up, they may be subject to what Marty Whitman likes to call a resource conversion activity. We would love to see that at these levels, but it does tell us that the single-family home market is better than it was. Banks are a little more comfortable with single-family homes as collateral values than they were not too terribly long ago, but it's not the red-hot market that people had hoped to see. Without creating higher paying permanent jobs, first time buyers are not coming back into this market. Without them, and until we get them back in, you do not have a robust housing recovery that pushes us forward. So, anyway, Jason Zweig was out in the Weekend Wall Street Journal with a wonderful article talking with Charles Ellis, head of a research firm. And Mr. Ellis has done some fantastic work on markets and investing over the years. And he's out saying that active fund management and stock picking has seen its day. That active fund managers are going the way of the dinosaur. Going to be some serious unemployment problems with that, folks. Lots of new waiters coming up in New York City and Chicago, if he's right about this. But he really thinks that the low-cost indexing is going to be the investment wave of the future, and that's what everybody's going to do, and the focus will be on asset allocation and things like that and not stock picking so much. That's one of the best things I've heard in a long time, and please, folks, get out there. Get your portfolio into an index, get it into the ETFs, focus on asset allocation. Do not worry about the businesses that make up the indexes, and certainly don't pay any attention to the valuation of those businesses relative to their asset and earnings power. Just ignore all that stuff, index it, keep your fees as low as absolutely possible, and focus all your attention on proper asset allocation, because that's going to make my life as a deep value investor so much easier. So unless you're subscribing to the Deep Value Report or Banking on Profits to take advantage of the tremendous opportunity that, according to Mr. Ellis, does not exist in small community banks, please index away. Guys, I've been doing this a very, very long time. There's 3 ways, and the academics will kind of back me up on this if you care to go and do the research, to make a lot of money in the stock market, to build a fortune, to beat the market, and none of them are indexing. Okay, there's three. One is earnings and price momentum, like my good friend Louis Navalier practices. Short-term momentum tends to carry over the next 6 to 12 months. As long as the earnings are going and the Momo crowd is on top of these things, they can push higher. That is a god awful amount of work. You're tied to your computer screen pretty much all of the time, and I'm just so intrinsically cheap that I can't pay 50 times earnings. Yeah, I've seen Louis do it in a blank, and he makes good money. Okay, he's generated solid returns over the years, and so have folks like the Treehouse Funds and some others that are follow the earnings and price momentum school. Cliff Asness has done some pretty good work on this recently with some of his papers. That does work. Most of these stocks, by the way, are smaller, not usually in the indexes. If they are, they're in like the Russell 2000 Growth Index or one of those. So again, it's not indexing, it's out on the far edge of the market. Now, the other way, of course, is to buy solid companies, good companies with great prospects, good dividends, but you only buy them in a market crash, a la Hetty Green, the one-time richest woman in the world who only bought panics and crashes, or our good friend Mr. Womack, the pig farmer who never lost money in his life on balance in the stock market because he only bought in crashes and sold 4 or 5 years later. The third way is, of course, the way we do it. That's deep value investing, buying stocks that are at a significant discount to their underlying asset value. The stocks in the bottom decile of all stocks in the market, ranked by price to book value, have continually, in every study I've ever read, just crushed the market. And those very, very few money managers, like say Donald Smith of Donald Smith and Company, that practice that lower decile form of deep value investing like we do, have absolutely crushed the market. And I've done pretty well myself with it over the years. We're lagging this year because we have so much cash in the portfolio and there's simply not a lot to buy. And I get asked occasionally, hey, does it bother you? You're not keeping up with the market this year with your deep value stuff. Yeah, no, it doesn't. I said I started doing this back in the 80s. I've seen it before. This today reminds me very much of the late 1990s, a little bit more of 2006. There's just nothing to buy. Now, some of my older portfolios of my own and my family's, we've got stocks from 2010, 2011, 2012. The returns are doing pretty well. Now, we're slowly but surely peeling out of this, and the cash balances are coming up just as they are in the newsletter, but we've done okay. So, handily beating the market since 2009, even with a little higher than normal cash balances. This portfolio was started in 2013, just about time we ran out of a whole lot of stuff to buy. We're going to lag a little bit. Our day is coming. I'm not overly worried about it. We're going to go sideways as Main Street and Wall Street catch up, or Wall Street's going to come down to Main Street's level, and we are going to be some very happy little buyers of cheap stocks. I think in 4 or 5 years, not 1 or 2 quarters. So we're lagging a little bit. Seth Klarman lagged last year as well. Do you think he really cares? Neither do I. We're just going to push forward with what we do because we know that it works pretty daggone well. Now, of course, the bank letter is just kicking butt. We've had 5 takeovers in that for an average gain of over 50%, and we got a whole bunch of stocks that are up 25, 30% since we started the portfolio. So then, great dividends coming in. That thing's doing very well. By the way, your chance, I've got at least 2 new stocks going into the portfolio this week. So if you're not on board and banking on profits, you might want to do that sometime this afternoon. Anyway, let's move back into the more interesting and exciting stuff. My Baltimore Orioles slipping just a little bit in the past week. 6 out of their last 10 that they've won. We've lost 2 in a row to the Chicago Cubs. So we're beating all the teams we're supposed to beat, but we lose series to the Cubs and the Indians. We got to do a little bit better than that. Hopefully we beat them today and avoid a sweep. Fortunately, the rest of the teams in the AL East are playing worse than we are, with the closest one, Toronto, I think, is at 5-5. So we haven't lost any ground. We've still got a very comfortable lead as we get closer to the first weekend here in September next weekend. But we need to avoid a sweep by the Cubs today. And we've got a very, very tough Tampa team. They got off to a rocky start this year, but let's not kid ourselves. That is a fantastic baseball team. We've got 4 games with them in Baltimore, so we really need to take that series from Tampa in our home field. Then we have the Minnesota Twins coming in. Normally, Twins, down around the bottom of the division, you think, hey, yay, 3 with the Twins. This is good. No, Twins beat the Detroit Tigers bat silly stupid 2 out of 3 games so far this weekend. They beat them 12-4 in one game, and on Friday they beat them 20-6. And that's the Detroit Tigers. That's supposed to be one of the better teams in baseball, but as predicted here, much to my friends at MarketFi in Detroit's chagrin, the Kansas City Royals riding young arms, great young talent, great manager, playing fantastic baseball, and they've opened up a 3-game lead over the Detroit Tigers. That's not insurmountable, but I like Kansas City's chances of rolling away with that division here because I think Detroit's going to implode a little bit going forward. Anyway, the battle in the AL West is going to be epic over the next 6 weeks. The Angels and the A's are tied, and you've got the great pitching staff at Oakland against some of the best bats in all of baseball, and a not so bad pitching staffs themselves at the Los Angeles Angels. This is going to be an epic run down to the finish. These guys stumble. Don't kid yourself. Seattle would be leading a couple of other divisions. They're 6 games back. Either those two teams stumble. The Seattle Mariners will be right in this thing because they are playing some great baseball. The West looks like a fantastic division race. I'm hoping it's a blowout race in the AL East and just a really tight, close race in the West. It'll be a lot of fun for the rest of us to watch. Now, preseason football is underway, and we got the Ravens are playing okay. They beat the Washington Redskins this week. Down here in Central Florida, everybody's excited to see that UCF standout Blake Bortles doing very well over in Jacksonville. Probably not going to get a starting spot, but he's going to have it before the year is over. You can almost guarantee that. Pretty exciting. He's playing really well. Philadelphia Eagles are playing well. Johnny Manziel is doing a lot of stupid stuff, but he hasn't looked too bad on the field. He ran for a touchdown last night. He's still not the starting quarterback. And San Francisco 49ers, they're playing today, but they look horrible. I mean, they're preseason Super Bowl pick. They've looked horrible. And guess what? None of it matters. Preseason football is the most meaningless indicator of anything on the planet. Coaches are trying out new schemes, new plays, new packages. Winning's not, unless you're Vince Lombardi or George Steinbrenner, winning in the preseason is just not that important. The real games start on September 4th with I think it's Green Bay and Seattle is the matchup. That'll be pretty good. And then we just kick the season off. Baltimore will have Cincinnati. That's when we'll spend a little bit more time on pro football because right now it's all just for fun games and practice. It doesn't mean anything. And it's horrible to watch most of the time, so we haven't done any of that. College football this week. This is starting to be a fun time of year, isn't it? My sentimental favorites, having grown up in Annapolis, the Navy midshipmen. The scheduler for the Navy has lost his mind is, once again, we're going to open up with Ohio State. We're going to come out and play the big boys right off the bat. A win against Ohio State next week would be just such a tremendous kick forward for the midshipmen. Looking for another Commander-in-Chief's trophy, another sweep of Air Force, and, of course, beat Army. So let's see how that goes. My adopted Florida Gators had a hard time picking a football team when I came down here because the Seminoles were the better team at the time. They probably are this year. UCF here in town has some pretty exciting stuff. But if you know me, you know that I have a fascination and admiration for the alligator. So Florida Gators makes great shirts, cool little crests. You'll probably see one going forward. They're looking to become the turnaround story of the year after going 4-6 last year. I think they've got the talent. If it holds up through the years, no injuries, the offense does well under the new package, I think Florida could end up once again back with a shot at the SEC title game. Let's hope I'm right. Okay, on the book front, it's the calm before the storm, folks. Not a lot coming out this week, but the schedule for September and October. Just think of your favorite author, and he's probably got a new book coming out over the next, he or she, I'm sorry, probably have a new book coming out over the next 8 weeks. It's kind of the pre-Christmas selling season. There's just a wave of stuff coming out. I don't know how I'm going to find time to watch all of the September and October baseball as well as professional football and college football and get all this reading done, but I do promise you I will get it done. Guy Spears' new book, which I'm really excited to read. He's done just such a fantastic job over the years. Education of a Value Investor will be out early in September. I cannot wait to read that book. Now, don't forget, Tobias Carlisle's new book was out last week, Deep Value. I'll be talking with Toby on Tuesday. We're going to do a little phone interview, talk about the book, some of his insights into the market. As you know, I'm a huge fan of his first book, Quantitative Value. And we'll see what new and exciting ground he has broken with this book when we talk to him on Tuesday. We'll get that interview posted up for you guys somewhere during the course of the week, and I'll notify you where it is. I did get followed by a guy on Twitter who I guess was searching for bank stocks or some such thing, but it's called Bankerstown. It's one of those Wall Street thrillers with, bond markets, mysteries, murders, all that. I'm addicted to those type of books. The second only behind Florida-based fiction is some of my favorite novels. So I ordered it. I'll let you know next week what I thought of it. It looks pretty good. All right, this week we got big numbers coming out all over the place. We got new home sales, we have durable goods, we have the Chicago PMI, Case-Shiller will be out, and unfortunately, it's probably going to show increases again pretty much across the country. If you want that first time buyer back and even the move up marker, housing prices need to slow down here a little bit. They've been really pumped up by institutional and cash buying. As those guys pull out, housing needs to kind of bump along a bottom here for a little bit and not continue to get carried away on the price increases. We don't need a V bottom in housing prices. We need a slow, sustained recovery. And we got personal income is out. That's a key number to watch. Been very flat and stagnant for some time now. Excuse me. And you have the University of Michigan Sentiment Index out later this week that have some pretty revealing information. Interesting earnings reports to watch this week is Tiffany. Are rich guys still getting out of trouble with their wives by buying the little blue box? We'll find out this week. And Best Buy is out. And some people are saying it's going to be better than expected based on cost containment. I think it's going to be a disaster, folks. People are just simply not flocking to the big box electronics stores the way they used to. I could be wrong. We'll see. It is a potential market mover. Our upside bonus this week is there are absolutely no unescorted Fed officials running around town giving interviews that kick the market up and down. So we don't have to worry about that, thank goodness, for at least 1 week as we head into the Labor Day weekend. Anyway, guys, we'll be back on a regular schedule. I'll have a little note for you all on Thursday. Subscribers will get all their regular stuff at their regular time. And that is all from us down here in Central Florida. Let's make it a great week, and then we've got Labor Day weekend to lay around and relax and enjoy the fruits of our labor. So it should be an interesting week as we bring the summer to a close. We'll talk to you guys next week.